March when we're recording this episode, and I think it's going to be released around the same time. So we are in the thick of tax preparation season. I'm going to use that word preparation because we're going to talk a little bit about tax planning and we're going to talk about tax preparation and what's the difference and what are the advantages. But we're having a lot of conversations with our clients regarding tax preparation. We just thought it would be helpful to kind of expose some of the tips and tricks, so to speak, in these common conversations that we're having. So we're going to talk a lot about business owners. We're going to talk about high income earners. We're going to talk about retirees or those preparing for retirement, and ultimately talk about the advantages of having a multi-year tax strategy laid out, right? Jeremiah, what do you think about that?
Well, this is one of the most common situations of taxes. Everybody pays their taxes. What's the famous saying? Death and taxes, right? They're coming for all of us.
Only two things that are certain in life.
Yeah. So taxes, everyone shares this sentiment of taxes that we all have to pay, calculate, figure out our taxes. But what we're running into, and we run into this a lot with new clients, is they're living year to year. It's almost like living paycheck to paycheck with your finances. So I have some money, I'm doing a thing, I pay my bills. Is there anything left? We have a lot of clients when they first get to us that they say, I had a year, I did some things, I had to pay my taxes. Is there anything left? That they're just kind of living year to year with their taxes. And often what we want to build in is a multi-year plan. So they have some visibility on what their taxes are likely going to be so they can plan for them. So they're not a shock. It is not an uncommon experience. And I'm sure there are listeners out there who feel this, that they get to the end of the year, they do their taxes, and they get the bill from the CPA telling them this is what you owe. And it's an absolute shock. It's more money than they have in the bank. They're not sure why it's so much. And then they go this, I say a tailspin, they go through a struggle to figure out how are we going to pay this bill? And it becomes a risk. I think it moves from just this idea that I have to pay my taxes to almost a business and a personal financial risk because they've got to come up with a significant amount of money very quickly.
And let's talk about what leads to those surprises. Markets can perform better than expected, right? So you could have more short-term capital gains. It could be that you have higher income that year. It could be that you have vested stock options that are going to vest and the value of the stock is higher than anticipated, so the withholdings weren't enough. It could be that you go through some sort of sale of an equity position or business ownership position, retirement. Surprisingly, we're going to talk a little bit about that later, as you step into your 70s, the date is reliant on the year that you were born, but at a certain point, you're going to have what's called required minimum distributions, and there's going to be a higher amount of taxes. I hate to burst anyone's bubble out there, but congratulations, you've sort of earned, if you have this large qualified retirement account, you've earned higher tax liability later on in life when those required minimum distributions come out. So there's all sorts of reasons that can lead to a surprise tax bill, but let me tell you, I have never heard of someone receive that with a positive mindset. I'm so excited to pay more in taxes this year. Furthermore, we're talking about how best to pay it. So we like to try to avoid that as best as possible.
Yeah, well, even to make it personal. I mean, Laura and I are married. We work together, raising a family together. And many times over the years, we have been surprised by taxes. And we're in this industry. Like we plan these things out, but we've worked on, jobs that we get bonuses, that we get commissions, and whatever tax planning we had done, didn't quite work out and it became a bigger bill, which is, as Laura was saying, it's a good problem to have. However, it can still be a problem. What we want to kind of focus in today is where tax 1 year, living year to year for your taxes becomes a real risk to a lot of households, especially as they're being more successful. As their business is growing, as their practice is growing, as their career is growing, the numbers are getting larger. And the surprise tax bills, maybe it was a couple $100, then it became a couple $1,000. We have clients that will have six-figure surprises. And man, that is so hard to plan for, even though they feel like they're thriving in their business, they're thriving in their job. It feels like a big step back. So we're going to talk about some of the things that we like to think about as we approach this tax season, not necessarily just for this year. It's just top of mind. But we like to think about what's the next 5 years? How can we set out a plan so this business and personal risk is mitigated and everyone can move forward with a good plan.
Let's talk for a second about tax preparers, whether it's a CPA that you work with. And we've talked on previous episodes about oftentimes our clients come into a new season of potential tax complexity, not just liability. And so we have a number of CPAs that we refer that kind of have a specialty in different areas or different levels of tax complexity. And so you don't want to find someone that maybe you have to pay more for them than the service that you actually need. And on the flip side, you might still be paying for a CPA that you have outgrown because your tax situation has become more complex. And in an ideal world, as the financial advisor, we like to have a relationship, a working relationship with our client CPA so that all of the strategy and the multi year planning that we lay out can be executed through the CPA. And that's really the ideal situation, is that there's an ongoing relationship that helps minimize tax liability over the lifetimes.
Yeah.
Anyways, if our listeners have outgrown their tax CPA, it doesn't mean they haven't served you well in the past, but it might be time to look for a new and better fit for your future.
Yep. A lot of clients, we have, they feel this when they're moving from like TurboTax or doing their own taxes to saying, hey, I think I need a CPA now, or I need a tax preparer. It's the same conversation. Say I had a kind of a basic level tax preparer, an EA or a CPA even, but now I need someone that's just more sophisticated. It's the same conversation. It's just making sure you have that visibility to someone that's going to be there.
For our listeners too, like you can remark on, can you sort of date a CPA? How do you compare different CPAs? What would you say?
Yeah. Oh, that's a great question. So we've had a number of folks where they will take an old, like the last year's taxes, and they'll take it to a new CPA and say, "Hey, I'm willing to pay, a few $100 or whatever it may cost for you to look over my last year's taxes and see if there's anything that we could have done different." And sometimes that's just looking over the shoulder or Monday morning quarterbacking, right? Sometimes it's not great, but often it gives you an opportunity to see, what the different CPAs would look at, what they would advise on, how they would structure things. I find this especially important when you're leading up to some changes in your life. You're now a business owner. You're now getting a number of K-1 statements. Your businesses are starting to thrive. You just need more. Well, you can have that new potential CPA look at your last year's taxes and say, is there anything that got missed? Is there anything different that we could be doing? And we've had a number of times where the CPA will look at it and say, well, it doesn't look like you're taking advantage of this. Has your current CPA ever talked to you about that? And often they say, no, I didn't even know that existed. And that's a great moment of
Hmm.
being able to, say, is there more that we could be doing here? It's hard for most people themselves just to look at their tax return and know if there's a good CPA or not, because it just looks like the tax form. It's hard to tell. So really having another professional look at it, it'll cost a little bit of money for their time. It's valuable, but have them look over it and see what might happen,
Yeah.
I think is valuable.
They can sort of unlock the tax return for you. So very
Yeah.
helpful. All right,
Yeah.
let's go ahead and dive in.
Yeah. Yeah. So everyone, as they go year to year, you have to pay taxes generally in April, unless you go on extension. For, I say, the majority of our clients, they also have to pay estimates. And estimates, with most CPAs, they do them 1 year at a time. Ideally, what we would advise is, chart out the growth that you're looking for in your business. Chart out the growth in your team, the growth in your business, the growth in your revenue, the growth in your profits, and then take an extra moment and chart out a growth in what estimates you have to pay for taxes. Most people skip that step, and it's not until the CPA tells them, "Hey, last year you made this, and this was your taxes. So we built your estimates based on last year, and this is what you paid all year long. And now this year you're at a higher level." And when you take a step back, to me it's a little bit silly. Of the business owner knew their business was growing. We as a financial advisor knew their business was growing. The only person who didn't know their business was growing was the CPA, and because of that, they put in these estimates that were related in the past. So one quick tune-up is to say, what were my estimates last year? What was my revenue last year? What's my revenue projected to be over the next few years if we hit our targets? And what should my estimates be in light of that? And just giving yourself a roadmap. So if hey, halfway through the year, we're doing better, we're doing what we want to do, you probably need to increase your estimates, which is not fun, but it's much more fun to do that slowly along the year or the few years
Mhm.
than to get hit with a big tax bill at the end.
One of the things I'm going to talk about is diversification. We talk about that all the time within an investment portfolio. But if you hold a variety of different style of accounts, they have different tax treatments. And so one of the indicators of low tax liability over time, or at least a portfolio that has a little bit more, let's say, flexibility and options available, is one that holds some funds in a qualified or tax deferred account, some funds in a non qualified or after tax account. Some potentially, if we're talking to a business owner, they could still have a lot of their net worth tied into the value of their company. But the overarching message here is that diversification among different types of accounts will help create some options when it comes to tax planning. If you hold a high concentration of your net worth in just one type of account, that could be problematic when you look at your kind of long term tax, I guess, risk or liability over your life. So that's something you want to look at.
Yeah. I love it when people come on as clients and they're getting close to retirement and they have, healthy retirement accounts, qualified accounts. They also have healthy Roth qualified accounts, and they also have a healthy trust account, regular taxable money. Each one of those has a different tax treatment, a different growth treatment, and having all of those accounts that have been funded over the years is so valuable to give them flexibility into the future. And so for us, just as Laura said, we're not looking to say put all the money here and all the money here. Often it's saying, hey, we're going to focus on this account for these years. And then for the next 10 years, we're going to focus on these accounts. And that's going to put you in a position that you have well diversified, like you said, not just holdings, but accounts that have different tax treatment. Such a valuable way to build your future.
Yep, yep. So let's talk
Yeah.
about, to some of our business owner clients, so those who can come to us with a plan for a sale of their business or of their equity position multi years in advance. Hey, I'm preparing for this. It's on the horizon versus, maybe 6 months before that type of event. There's a lot more strategies that can be gained. Obviously, time is on your side in this case scenario. And even if you don't know the exact figure of what you're going to sell your business for, you might have kind of a valuation or an expectation. You might even be able to structure the agreement, right? The purchase agreement in such a way that would benefit you from a tax planning perspective. There's really powerful decisions that can be made when time is on your side. And there's even more. Jeremiah, do you want to talk a little bit
Yeah.
about those years where you anticipate a huge spike in your income?
Yeah, that's well said. So most people think about the deal first and the taxes second, and which what that often does, it means they sell the business in a year, and then as soon as they sell it, they then turn around and say, "Oh yeah, taxes. What do I do?" You're kind of locked in at that point. There's a few things, depending on what month of the year your sale happens. There's a few things you can pivot to, you can do last minute, but a lot of those are smaller in the impact. Really, what we're looking for is anybody who is, 5 to 10 years away from an exit. We want to start having conversations about their estate planning, their tax planning, their succession planning, the sale, all of those items, not because we have to have it all figured out. We don't, right? It's down the road. However, if the sale is coming and that's what the exit is going to be, there are some clear structures to get in place that will make this better. I'll just throw one out there. There's a number that we talk about, but I'll just throw one is QSBS, qualified small business status. This is not for everybody. There's a lot of places where it doesn't make sense. But if somebody is a C corporation, taxed as a C corporation, and they have an original issuance of stock to themselves, usually it means they're the founders, and they've had this stock for 5 years, the government allows a $10 million capital gain free pass in essence. And most people don't even know this exists, but it's not something you can do the day of. It's something that has to be structured, knowing you're going to reach a sale. So if a business is started, they're the founder, they anticipate they're going to build it and sell it. Man, to stay a C corp and not become an S corp, have some of these other structures in place. They don't make sense if you have a different goal in mind. But if the goal is to sell
Mm-hmm.
it, these can make huge benefits. There's even something called QSBS stacking, meaning you could have multiple trusts with multiple QSBS elections to have
Mm-hmm.
10, 20, $30 million of a sale exempt from taxes. And for
Yeah.
some people, hearing this, that just might, blow their mind that that even exists, but it takes structuring. It's not something you can do one year.
Yeah, and that talk about the team that you need to support that takes, a complex level of estate planning. So you need an attorney on your team as well to be able to make that happen. We talk to our clients who are charitably minded about the benefits of planned giving. There can be a bunching strategy, there can be a multi-year tax planning strategy. We've talked a lot on our episode about donor advised funds, which is essentially a bunch giving strategy other than you get the full tax benefit in the year of creating the donor advised fund, and it bifurcates or it's separated from the time of the gift. So you could give from that account over time, invest those funds. There's other strategies that really can be beneficial in that structure with the donor advised fund. But for those clients that are anticipating a higher earned income year than typical, something like a donor advised fund might be really powerful. So when you start to combine these strategies together, that's when you really need some time to prepare, some time to interact with our client's CPA to make sure that we're executing on it. We need to sharpen our pencils and get really specific about the amounts and So these take time. It's not something that you're going to do just between January and your filing date in April, right? There are some things that do take time to be able to structure.
Yeah. I got two more I think that are useful for a lot of folks. The first one is kind of low hanging fruit, but it's retirement accounts. There's a lot of business owners that we will work with that don't yet have the appropriate types of qualified retirement accounts on their business or access through their job, and they're not maxing them out. I mean, maxing out a retirement plan 1 year or 2 years doesn't do a whole lot. But if you are maxing out a retirement plan, especially if there's profit sharing involved for 3 or 4 or 5, 10 years plus, it makes a huge difference on what your future looks like. So that's one. It's kind of low hanging fruit for a lot of folks. The other that can be a little reactionary, but still takes plan is opportunity zones. And we could do a whole episode on that. Maybe we will in the future. The big, beautiful bill that came through this year changed some of the way the opportunity zones work. In fact, it made them permanent. So this idea of opportunity zones is going to be around into the future. And starting 2027, there's a whole new set of rules of how these work. But in essence, and in brief, you can take gains from a sale of an asset. And instead of keeping those gains, you can roll them into an opportunity zone investment and you get some major tax benefits. Some of it's a step up in basis. Some of it is just deferral on gains. Some of it is actually the forgiveness of gains in the future. So there's a number of great benefits that are potential for someone. So if someone needs the money in the sale, it's not a good option. If someone says, I need some of the money, but I could delay receiving some of this money and get some tax benefits, it can be a great benefit in the year of a sale. And just as Laura said, one of these is nice, but when you combine 4 or 5 of these different things, to the extent they make sense for your future, they become extremely powerful for what you're
Yeah.
building.
Not to mention the impact, the real impact it can have on a community. Opportunity zones are investment in the development of lower socioeconomic territories within certain regions all over the US. And so you can actually go online and look at a map of opportunity zones that are near to you or in other places within your state. And so I love the purpose behind the opportunity zone as well. And there's a lot more that we could talk about there. So I think you're right. We could do a whole episode on that. You mentioned retirees, and we've been talking a lot about business owners so far. But one of the things that I want to talk about is to our retirees or those who are anticipating retirement. And they are so thrilled that then, for the first time in their life, they might have their lowest tax bill. But as we all know, as you step into retirement, sometimes your cash flow can come from multiple sources. You might have a pension, Social Security, you might start withdrawing from some of your retirement accounts, etc. Right? So there's some tax layering, like planning that we have to do in that season as well. But for those of our clients who have built up a high value in their qualified retirement account, and they know that sometime in the future they're going to be required to take a required minimum distribution from that account. I love the visual aspect of our planning software when we do this, but essentially you can see that there's kind of a dip. It's sort of a V shape. You have a dip in your tax bracket or tax liability as you step into retirement. But then as soon as those RMDs kick in, you're right back creeping up. You might even end up in a higher tax bracket in the later season of your life than you did when you were earning income in your career days, right? And so people oftentimes don't think about this the things that we leave to our future self to worry about, right? Let's add
Yeah.
that to that list. But what we like to do, if we're thinking about it more of like this V-shaped kind of a teeter totter, is that what we want to do is try to pull down your tax liability in the future by intentionally triggering tax in that lower tax bracket season just after retirement. And many of our listeners may have heard of or know about Roth conversions. And this is a great season to maximize Roth conversions, not to mention when we talked about that charitable giving strategy earlier, right? So again, this is a layered strategy where you're intentionally triggering tax at a lower tax bracket status in your life in order to reduce your future tax liability. And the numbers can be tremendous, right? So you're saving your future self hundreds of thousands, if not more, sometimes in tax liability. And again, that takes some advanced planning to accomplish.
Yeah, very much advanced planning, and no one is not no one, most no one is going to raise their hand to volunteer for more taxes in
Ooh,
the
ooh,
season.
let me pay more taxes.
Right. In a season where they are finally at a spot where they're paying low taxes. But what some of the graphs, the charts that we help, show clients is to say, hey, if we're strategic in these years, that's going to give us a future benefit. And again, this type of idea of a Roth conversion, especially with a donor advised fund. It's not a 1 year thing, right? It's something that we want to do over, say, the course of a decade consistently. every year for 10 years, that's going to make a major impact on someone's future. But it only makes sense if that aligns with where they're going. So part of having a holistic plan, part of understanding where you're headed, what you're about, and what strategies are going to get you. That's where we like to live. And I think in this moment of taxes, I think it's just great for people to consider, am I on track with my taxes? Not just for this year, but do I have a plan? Do I know where I'm headed? Do I have the right support to really tune up your taxes?
Well, I was either talking too slowly or our listeners were listening too slowly. I don't know which one, but we're nearly out of time. So if you've listened to 20 minutes worth of tax advice, kudos to you. But overall, if you are listening to this and you're thinking like, yeah, my future tax liability is a, total black hole. I have no idea what's going to happen, or you feel constantly surprised by the tax burden at the end of the year, or simply you would just like to have more advanced planning, these are opportunities to come and talk with an advisor and be intentional about your tax liability, because there are tips and tricks that are absolutely legal. They just take time to prepare and will hopefully create an advantage for your tax liability over time.
Until next week, folks, when we grow in wisdom and knowledge. Thank you for listening.
A few more things to let you know about before we go. Podcast reviews really help us to serve more people and get this information into the hands of the people who need it. Please leave us a review. Even if it's not 5 stars, we welcome the feedback.
And we invite you to let us know what topics you would like to hear more about, or what would benefit the people in your life who you're closest to. We have more resources online. Those resources are designed to help you share this great information easily with people in your life. To access those resources, please visit tricordatvisors.com.
Often we hear from clients that they wish they had talked to us sooner. If that's you, we'd be thrilled to see how financial planning can benefit your life. Email us at contact@tricordatvisors.com or simply click on the link in the show notes.
We love creating content that's useful, resourceful, and maybe even a little entertaining. We want to make this mega universe of financial topics and advice applicable and helpful to your life.
Remember, at Tricord Advisors, we are your future's best ally.